The G7 countries have agreed on a global minimum tax of 15%. For Ireland, that poses problems. After all, the country attracts large international corporations with low rates. Now the country wants to keep the companies with other advantages. No corporate tax was payable for Microsoft Round Island One, an Irish subsidiary of the US software group, last year. The division that collects royalties for copyrighted software has made $315 billion in profits. But it is residence for tax purposes in Bermuda, where there is no corresponding tax. It was a special case as a result of an internal reorganization, emphasized the company, and added that it strictly adheres to the tax rules and laws of the respective countries. Internationally, such optimizations of the tax balance by multinational corporations have been in the focus of governments for years, even if they are legal. Taxation where the profits are made has long been the goal of many heads of governments. Since the G7 summit of finance ministers at the beginning of June, a fundamental change in the international tax system has emerged, which is intended to make it much more difficult to shift profits to low-tax countries. The agreement provides for a minimum rate of 15% in corporate taxation. If a country stays at lower rates, the difference could be added at the headquarters. But Ireland, of all countries, is very skeptical about this move, although Finance Minister Pascal Donoghue missed out on the billion-dollar profit made by the Microsoft subsidiary, which accounts for almost 3/4 of the country's gross domestic product. With a corporate tax rate of 12.5%, the country itself is below the limit proposed by the G7. And it also wants to stick to the rule in order to keep investments and jobs in the country, stressed Donoghue last week. Ireland will strongly advocate legitimate tax competition, said the Treasury Secretary. In the upcoming round of multilateral negotiations by the Organization for Economic Cooperation and Development, the OECD, on taxation, Donoghue is likely to point out, as has regularly been the case in the past, that tax policy should serve as a lever for smaller states to offset advantages that others owe to them, size, location, or raw material deposits. With its low tax rates, the island is always affected within the EU. In the 1980s, an even lower rate of 10% initially applied to the manufacturing industry, as well as attractive special services for financial service providers in Dublin. In 2003, the current rate of 12.5% was introduced for all companies. It regularly brought charges of fiscal dumping to the country by EU partners, especially Germany and France, with their rates almost 20 percentage points higher. Numerous US corporations have opted for Ireland with their branches in recent years. Apple, Google, Facebook, Twitter, and LinkedIn have their European headquarters in the country. Airbnb, Amazon, Etsy, PayPal, and Salesforce are represented with large locations. It pays off for the tax authorities. It collected 11.8 billion euros in corporate tax last year. An even more important part is only the income tax, which is considerable in contrast to the company rates in the country. High earners pay almost 50% on income over 34,000 euros. If the new international rules come, they could create a significant gap in tax revenues. Part of the profits would be booked elsewhere in the future. In addition, the attractiveness of the location for new settlements is likely to suffer. According to initial calculations on the basis of the present proposals, the government is calculating with 2 billion euros less tax revenue for 2025. The Independent Court of Auditors puts an even higher figure at 3.5 billion euros. The influence of international corporations in the country is so significant that the Statistical Authority has presented an adjusted figure for gross national income since 2016 in order to provide a better overview of domestic economic activities. The measure of the country's prosperity is adjusted to take account of globalization effects that disproportionately affect Ireland's economy as a whole, according to the explanations given by the statisticians. In other words, the profits of many international corporations do not stay in the country after taxation, but flow to owners abroad. The gap between the original and the adjusted key figure has increased continuously over the past few years. In 2018, the adjusted gross national income was 198 billion euros, 23% below the original value. But even if the tax framework has had a significant impact on the country's economic success in recent years, it is not solely responsible for it. Some people roll their eyes when you refer to Ireland's other advantages besides tax. Gareth Lamb, head of Facebook Ireland, said at a recent event for the American Chamber of Commerce in Ireland. Each of these aspects cannot be compared with a tax advantage, but all in all they are considerable and strong. The manager sees the country in a very good position. Ireland is not a mere tax haven for mailbox companies anyway. The American Chamber of Commerce alone has over 700 US companies in the country. They employ 160,000 people, plus another 130,000 positions that are directly dependent on US companies. The well-trained workforce has made the island attractive for decades. Until the 1960s, the predominantly agricultural state regularly sent streams of immigrants into the world. But with the first direct investments from Europe, the USA and Japan, came jobs and the need for training and further education, especially in the natural sciences and technical fields. A number of universities and educational institutions were founded at the time. However, many young Irish still like to spend a few years abroad, which makes them attractive for employers at home. Other bonuses, especially for US companies, are the English language and the access to the EU. The country's economic rise is also not the same as the introduction of low corporate taxes. Ireland had already caught up with the average income of the EU countries in the 1990s. When it joined 20 years earlier, it was less than 3/4 of its value. Step by step, the government is now also bowing to the new reality. A change is becoming apparent, said Europe Minister Thomas Byrne in a television interview a few days ago. Ireland is determined to work with the OECD on the change. The tax has been very attractive for companies in recent years, he admitted. But many of the companies that came for the tax are happy to stay because of the good training and business-friendly policies. And I have to add another point there. They are now at 12.5% and the minimum tax rate will be 15%. If they go to the minimum one, which is still legal then, it's still almost 20 points below Germany and France, for example. So it's 2.5% points up, yes, but still almost 20 percentage points below several other countries. So I don't think it will be that bad. But of course, 2.5% in tax is a lot for some very greedy companies. And there could something much worse happening, that they have to be taxed where the services are used and where the products are used and bought. So if everything we use here in Germany has to be taxed in Germany, that is what I would love to have. Sorry, Ireland, but that would be a fair thing to do. And only the EU as a whole can do that. And so there will be discussions for years, as we already have discussions for years, because it's good for some and bad for others. So that takes years. Of course, everybody can say now, yeah, the EU never gets to a conclusion, talks for years. That is one topic where they deeply disagree on. But on topics they can find compromise, it doesn't take that long, as you can see in tons of videos I made about the European Union and the German presidency, the Portuguese presidency, and I will make those videos even with the Slovenian presidency coming up, with the France presidency after that. There will be a lot of things that are agreed on and that happen. But this is just one where I don't see this in the near future. I'll see you in my next video. Auf Wiedersehen.